One of the biggest lies that banks tell is that money grows when left in the account. Warren Buffett has always warned, the real risk is not volatility, it is the silent loss of value. In this video, you will learn about 9 safer assets than leaving money idle in the bank, to halt the erosion of your wealth and help you create intergenerational wealth. And the 8th on the list often goes unnoticed even by the most experienced investors. Think that for decades, we have been led to believe that leaving money sitting in the bank was the utmost synonym of safety. But this is a half-truth. Even with positive, nominal interest rates, the real yield can be negative, especially when silent inflation advances year after year. In other words, the number in your account may even increase, but the real purchasing power is decreasing. To prove this, it is enough to look at the accumulated inflation here between 2013 and 2023. €100 today buys less than €75 bought 10 years ago, and the trend is set to continue or even worsen. What are the large investors doing to escape this invisible trap? Let's examine each of the 9, starting with the first. Inflation-linked government bonds are the most direct way to protect your money from the silent advance of purchasing power loss. In practice, these are loans that you extend to the government. But with a difference, they pay a return linked to the official inflation rate of the country. In other words, if prices rise, your capital grows accordingly. Unlike money left idle in a bank, which loses real value over time, these bonds keep your wealth adjusted to the cost of living. And best of all, they are considered the safest assets in the country. In a systemic crisis, the issuer of the bond can print money to pay. But the bank where your cash is held may not have the same resource. But what if it is possible to combine real protection with a constant flow of passive income? The next asset delivers this. Real estate continues to be one of the most consistent ways to protect capital in the long term, while money sitting idle in the bank generates no return. Well-located properties produce recurring income through rent. Most importantly, in the majority of contracts, this amount is adjusted for inflation. In addition to preserving purchasing power, you also receive a continuous return that is corrected over time. In the case of real estate investment trusts, you also gain liquidity. It is possible to buy or sell shares with just a few clicks without worrying about the bureaucracy of deeds, maintenance, or tenants. A tactic employed by large managers is to diversify geographically, buying properties in different countries. This reduces local risks and makes your assets even more resilient. But what if, in addition to protection against inflation and recurring cash flow, it were also possible to capture capital growth? This is exactly what is possible with the next asset. Many people think that stocks are like a roller coaster. However, experienced investors see them as a combination of stability with return, especially the category of stocks that operate in essential sectors, such as energy, health, utilities, and food, segments that maintain revenue even during recessions. When investing in such companies, you become a partner in a solid business and start receiving part of the profits regularly. Unlike idle cash, this stream of dividends can be reinvested to accelerate the growth of your wealth or used as a supplementary income. An important point is the sustainability of this payment. The so-called payout should be balanced, high enough to be attractive, but not to the point of jeopardizing the company's financial structure. This way, the company can still reinvest these profits to continue increasing revenue and dividends over many years. This compounded growth offers a protective effect against inflation and strengthens the accumulation power over decades. Moreover, to simplify selection, there are funds that gather various defensive stocks focusing on stable dividends, without the need to choose manually. But what about when confidence in currencies and companies seems unstable? There exists an asset that has traversed centuries as a physical and universal store of value. Gold has always held a special place in value preservation strategies. This is no coincidence. Unlike financial assets, physical gold does not depend on the health of an issuer or an electronic contract. It cannot be printed or devalued by an emergency monetary policy. Therefore, in context of geopolitical instability, artificially low interest rates, or rampant monetary expansion, gold re-emerges as a classic protection. It has been doing so for centuries, Interestingly, despite not generating cash flow, it serves an irreplaceable function, being a timeless reserve of value. If you look at gold's performance compared to the euro, over the last 2 decades, you will see a remarkable difference. While the European currency has gradually lost purchasing power, gold has more than doubled in nominal value during the same period. This is no coincidence. It is a direct effect of scarcity combined with the depreciation of fiat currencies. You can access it physically through secure custody or via backed digital structures that facilitate buying and selling. Both forms have specific advantages, and it all depends on your allocation strategy. But what if you want to protect yourself from inflation with assets that not only preserve value, but also benefit from global price upswings? That is where the next asset comes in. Commodities are real tangible assets that the world needs to function. Oil, natural gas, industrial metals, and agricultural products. All these resources have one thing in common: intrinsic value. Unlike stagnant money, which can be eroded by inflation, commodities tend to appreciate in value when the cost of living rises. Historically, during periods of excessive monetary printing or geopolitical conflicts, the prices of these raw materials increase. This is because they are scarce, essential, and traded globally. An increase in production costs, transportation, or limited supply directly impacts their value. Investing in commodities does not mean buying physical barrels or sacks. Today, it is possible to gain exposure to this market through specialized funds, which offer diversification across various sectors: energy, metals, and food. Each reacts differently to economic cycles, and that is where the strength of the strategy lies. But what if you wanted to completely exit the traditional financial system? If your priority is to protect capital with something that cannot be printed, manipulated, or reproduced, the next asset is for you. It has been attracting attention from the largest billionaires in recent years. While a large portion of traditional investors concentrates their resources in financial assets, a silent elite has been consistently increasing its exposure to a specific type of real asset: agricultural land. Purchasing land on farms is not just an ancient tradition. It is a wealth protection strategy that has gained new relevance. These assets combine 3 rare characteristics: practical utility, natural scarcity, and low volatility. Well-located land will continue to generate value, either through direct production or passive appreciation over time. And unlike a paper asset, no one can print more fertile soil. Not surprisingly, public figures with access to privileged information, such as Bill Gates, Jeff Bezos, and Elon Musk, have increased their holdings in this type of asset. In many cases, this is through direct acquisition or participation in private agricultural funds that operate on scale and efficiency. In addition to protection against inflation and preservation of value, there are also succession and tax advantages, especially in countries with regimes favorable to the agricultural sector. And if you think that land is too illiquid or out of your reach, you may prefer something more digital, decentralized, and globally accessible. An asset that many still do not comprehend, but has already proven to be the asset that has appreciated the most in the past 10 years. In recent years, a completely digital asset has challenged all traditional ideas about the store of value. Bitcoin, despite its volatility, has proven to be an effective instrument for preserving purchasing power in the long term, especially when compared to fiat currencies. Its main characteristic is the fixed monetary policy. There will be a maximum of 21 million units. This makes it immune to inflation from monetary base expansion, a recurring problem in state currencies. Over the past 10 years, while the euro has gradually lost purchasing power, Bitcoin has multiplied its value by tens of times, even with temporary declines. Additionally, it is liquid 24 hours a day, 7 days a week, divisible into minimal fractions, and can be stored without intermediaries. Something impossible with any other asset on this list. Many already refer to it as digital gold, with the difference being that it is accessible globally and without geographical barriers, even for those most opposed to its adoption. Holding 1 to 3% of a portfolio can serve as a hedge against macroeconomic instabilities. Now, what if there were assets that, in addition to protecting value, were also used by elites as a form of silent diversification? Let us move on to the 8th asset on the list. Imagine an object that you purchase, use for years, and still sell for more than you paid. This seems rare, right? But this is exactly what happens with certain luxury items, such as high-end mechanical watches. They have been gaining an increasingly relevant role in sophisticated wealth strategies, and not only as status items. These assets combine scarcity, continuous demand, and cultural value, a triad that, when well chosen, translates into the preservation and real appreciation of capital. Some classic models have become true collectible assets. A notable example is the Rolex Submariner model, which over the past 10 years has appreciated by approximately 180%. This easily surpasses various traditional investments over the same period, and without the same degree of exposure to systemic risk. These items have global and specialized secondary markets, allowing for secure transactions with guaranteed authenticity, which facilitates both the entry and exit of these assets. Of course, this is not about impulsive consumption, but about strategic choices within established brands with a track record and recognition in the collector's market. And now, on the last asset of the list, a conservative financial instrument with legal protection, predictable returns, and ideal for medium-term reserves. It is still used by investors who prioritize safety above all. Certificates of deposit are highly secure financial instruments offered by banks with fixed returns and legal guarantees. Within the Eurozone, this protection covers up to €100,000 per institution, making these assets especially attractive for those who prioritize predictability and asset protection. Unlike money that sits idly in a current account, which loses value due to fees and inflation, CDs offer guaranteed returns over a defined term. Simple, straightforward, and consistent. For many prudent investors, they continue to serve as the first layer of a well-structured defensive strategy. Of course, no asset is perfect on its own. True protection comes from a strategic combination of different types of investments, each serving its specific role within the portfolio. While some preserve value, others generate income or provide liquidity. You can also use economic cycles and inflation as a compass, adapting your portfolio to the reality of each moment. And the best part, there is no need to start big. The essential thing is to begin and then to remain aware. Now imagine your assets working with balance, predictability, and real security. If you have watched until now, congratulations. This already puts you years ahead of those who still believe that idle money is synonymous with security. Please like the video and subscribe to receive more content on wealth preservation and growth. Also comment on which of these assets are already part of your strategy. Every conscious choice today is one step less towards uncertainty tomorrow. See you in the next video.